Hey, how you doing? Top producing loan officer Sean Shiles from the fifth largest bank in the United States. So this afternoon, there was a huge announcement by the Fed today to actually move the Fed's fund rate by 50 basis points. That's a lot, man. That's a 0.5%. So I keep getting these phone calls since like 2:30 of, hey, Sean, how come if the interest rates went down 50% or 50 basis points, how come treasuries are going up and how come the stock market is going down? First of all, banks actually what they're doing is they're forecasting the market and saying, hey, if everybody is telling us that they're going to actually reduce rates in the next 3 weeks or next 6 weeks, what they're going to do is they're going to actually push down their rates based on that. And they're going to hedge their bet a little bit on, then they're going to do it on the long-term rates. The next thing that they're going to do is that they're going to look at it, and if they feel as though they went too much or too little, they're going to adjust accordingly. So that's number one. Number two is, why would 10-year treasuries go the other direction? Is because, in some cases, 10-year treasuries are a long-term hedge. And what some of the economists and some of these guys who are betting on the stocks are saying is, hey, if the Fed is cutting rates, maybe there's a reason for it, and maybe there's a reason for concern. So they're going to pull back a little bit, and the market did pull back a little bit, and 10-year treasuries actually went up a little bit as opposed to going down a little bit. The next question is, if that's happening, how's that going to affect the real estate market? Well, the real estate market is a different story. And if you watched Powell's announcement, he was actually specifically asked, how's this going to affect the housing market? What's interesting is his answer was kind of convoluted. But at the end of the day, what he actually said is, hey, we really can't control housing. What we can control is monetary policies, which is what they do. And their job is to basically monitor unemployment and monitor inflation. And that's really what their mandate is. It really doesn't have anything to do with housing. But obviously, everybody knows if the Fed fund rate goes down, interest rates go down, prices on homes goes up. And right now, we have pretty much 2 to 3 people for every one house that's in the market. So there's high demand. And with interest rates going down, I think you're going to see it really make a big impact. So how do you play the market? How are you going to buy your next house without making 5 costly mistakes? What you're going to do is you're going to click the button down below. You're going to grab our North Jersey Home Buyers Seminar. We're going to be doing it on Facebook and on Instagram. You'll be able to get on there, but you got to grab a seat because we only have 150 seats. We've already given away about 75% of those. So if you want to get a seat in our webinar and find out how to buy your next house without overpaying, without actually making the huge mistakes that most people make, which is getting stuck in bidding wars. They actually end up overpaying, or they end up settling in a house that they really didn't want, or it's all the above. If you want to find out how to avoid that, jump on the webinar. We're going to show you how to do it. I've been doing this for 30 years, and I've actually helped over 2,000 people buy, sell, or invest in a home. I want to see you on the webinar. My name is Sean Shiles. I'm the top producing loan officer of the fifth largest bank in the United States, aka the Realty Coach, and I can help you actually put more money in your pocket and less money paying out every month and live in the house you want to live in at the least amount of interest and the least amount of fees. Give me a holler. We'll see you on the other side. Grab the link below, grab on the webinar. Talk to you.